Hi everyone, I hope you are all in a good shape, strong and in the mood to follow this video. If not, take a break and get back later. In this video, I will discuss basics of IPOs and the typical mechanisms and processes that are involved when a company goes from private to a publicly traded entities. There are several potential reasons why a company may want to become public or get listed in a stock exchange. Some of the reasons are typically more important than the others, which are highlighted in bold in the slides here. The first and most common reason that is typically cited is the need for capital. If the company does not have access to enough private capital or private capital is not cheap, it may want to decide to go public to raise money for future investment and the growth that is needed. Overvaluation may be another reason to go public in case public markets overvalue the company way more than the private markets. A clear example of this is the huge rush of very young companies without any proper business or business model to become publicly listed companies in the tech bubble of the 1990s. Another important reason why companies go public is that owners want to cash out. They need liquidity. Owners could be venture capitals, founders, or employees that have been compensated with stocks and options. The process of going public may allow the founders to become diversified by selling part of their wealth in the company and invest it in other businesses or assets. Also, becoming public brings more transparency and less uncertainty about the company to investors that may be valuable for the company. By going public, the company also gets attention of the media, so it may work as a marketing device too. One of the most important reasons, and perhaps most ignored one, why companies nowadays go public is to have a publicly traded market value. This is very important since a public company can then easily use its stock as acquisition currency to pay for acquiring companies instead of paying by cash. In addition, when companies have a publicly traded stock, stock-based compensation has a clear and transparent value to employees who receive them. Given that a large part of compensation of high-skilled employees in young companies come from stock-based compensation, this could lead to attracting better employees as well. Finally, in public companies, the management can get a constant feedback from the market by looking at changes in the market value as a response to some changes in company strategy or so on. For example, following the announcement of an acquisition, if the market price of the acquirer drops significantly, it tells the management that the market believes this is not a good acquisition or the price that is paid is too high. Of course, this does not mean that the market is right, but it's a feedback using all information from the market, which turns out to be very valuable to the company in many situations. One important observed pattern during the past decade or so has been the tendency of companies to grow much more while still staying private. In the older days, the process was the following. Companies are founded. After some years of growth, they had to go public to be able to raise capital for their growth. And after several years of being public, they would reach valuation in the range of $10 billion or so. As you can see from this graph, nowadays there are more and more companies that can grow a lot, reaching tens of billions of dollars valuation without going to the public markets. Part of this pattern is definitely due to much more availability of private equity and the company's access to private funding. In fact, as we will see later on, many companies do not report the lack of private funding or the need to raise capital as the main reason behind their decision to go public these days. Part of the tendency to stay private could also come from increases in the cost of becoming a public company. But you may ask, what are those costs of becoming public? The first and most direct cost is transaction fees. This is the fee that is paid to investment bankers and other parties involved. Typically, total transaction fees amount to 10% of proceeds from the IPO, with about 7% underwriting fees in the US. Of course, this number is different across countries. Other costs include mandatory information disclosures and reporting requirements, the short-term pressure from the market, potential loss of control since part of the shares will be sold to outsiders, and so on. Finally, underpricing of offered shares in the IPO is another cost to the firm shareholders. These shares are typically priced lower than their value by the investment bankers, which typically mean that the company sells shares with a discount. The underpricing is computed by the percentage increase in the price in the first day following the listing. The magnitude of underpricing varies across countries and years, but it has been around 15 to 20% on most of developed countries on average. Interestingly, this is a persistent phenomenon that has been observed for decades and is still there. As we will discuss, part of underpricing is due to the way traditional IPOs work, and more specifically the clear incentives of bankers to underprice the offering. This, however, does not seem to be the whole story, since we do observe underpricing in other alternative ways of going public too. This graph is very interesting. It's from a study that surveys CFOs of many companies about the motivation behind their decision to go public. As you can observe, the most important reason, according to the company insiders, is to create public shares for use in future acquisitions and to establish a market price or value for the firm. Please note that running out of private equity is ranked as one of the least important factors here. Here you can see some examples from companies I believe you know and what they mention in their IPO filing as important reasons behind their decision to go public. As you can see, one of the important factors is indeed creating a public market for their stock, which, as we discussed, by itself could be very valuable to companies. Now let's go through the mechanics of IPO process. When companies consider to go public, they will have to choose financial advisors or investment bankers to help them going through the process and underwrite the offerings. Typically, there is a lead underwriter who creates a syndicate of banks to help with selling the shares. After choosing the bankers, the firm files for the IPO to the relevant authorities to get the green light for going public. Then the roadshow starts. The roadshow is the process in which bankers go to different cities and different countries and have many meetings with their clients, essentially institutional investors such as hedge fund, money managers, and so on, to determine their demand for the shares. This process, also called book building, since the underwriter attempts to build a book based on institutional investors' bids for the number of shares they are willing to buy and perhaps the price they are willing to pay for each share. It is important to note that the bankers try to come up with a price range for the shares before going to the roadshow to have a reference range for the value or price of the company. After the book building process is finished, the bankers set an offering price. A very important point to highlight is that in the traditional IPO process, the bankers guarantee that they will sell all the shares with the offering price that the bankers themselves propose. In practice, the way it works is that the bankers have to buy all the shares from the company at the offering price and then tries to sell those shares to their clients. Therefore, if the banker cannot sell the shares at the offering price, it is the banker who incurs the loss. If you want to compare this situation with when you want to, for example, sell your home, is the following. Imagine the real estate guy has to guarantee a price at which he will for sure sell your house. Otherwise, he will pay the difference from her pocket. Do you think he will set the fair price for your house? If he is literate like bankers, he will definitely underprice your house. So this is an important part when the bankers set the offering price, and essentially they have to set a price that they are sure they can sell all the shares. The bankers wait till the night before the company plans to go public and become listed to make sure that they are accommodating all information in there. When the price is set, then they start to allocate shares to their clients. When allocations are done at the offering price, the market opens the day after and an opening price is set in the stock exchange based on the demand and supply for the shares in the public market. Note that this opening price could be way higher or lower than the offering price. Also, note that this last step, that is essentially an auction to determine the opening price, happens every single day for every single stock. The difference in here is that for an existing public company, there is a clear reference closing price in the day before, and therefore, unless there has been a big news during the time that the market is closed, the opening price today will be very similar to the closing price yesterday. But for a company that is just listed, there is no proper reference price from yesterday, and therefore, to clear the market and set an opening price, it may take an hour, more or less. When companies go public, there are two types of shares that could potentially be sold. The first is the new shares that is offered by the company. These are typically called primary offerings. The second type of shares sold are those that belong to existing shareholders. As mentioned before, some shareholders cash out when the company gets listed. In many IPOs, there is an agreement between the company and underwriters that is called lockup period. During the lockup period, that is typically 180 days, no insider can sell his shares. Of course, insiders can typically sell their shares at the offering date, but they have to report this in the filing. In terms of mechanisms for selling shares, the most typical one is the one we mentioned, that the underwriter guarantees selling of all shares. This is called firm commitment. For smaller IPOs, banks may use best effort process in which the underwriter tries to sell the shares with the best possible price, but there is no guarantee. Another type of setting the offering price and allocating shares is via auctions. In this process, the price is set so that the demand at that price equals the supply. Every investor who has a bid equal or higher than the clearing price will receive the shares. One typical item that is seen in firm commitment mechanism is something that is called over-allotment option or greenshoe options. This is essentially the option that is given to the underwriter to buy 15% more shares at the offering price. The bankers typically short sell those shares at the beginning, and then in case the offering is not a success and the stock price goes down in the market, the underwriter buys back the shares with a lower price than the offering price and return the shares back to the company. This way the bank supports the prices not to go down too much.